Investing in the stock market can be one of the most rewarding ways to grow your wealth over time, but it's not without its risks. Every investor dreams of making smart choices that yield impressive returns, but the path to success is often riddled with pitfalls. Unfortunately, many of these mistakes stem from human psychology, lack of preparation, or the temptation to chase quick wins. Avoiding these errors can be the difference between building a thriving portfolio and watching your hard-earned money disappear. So, what are the huge mistakes that investors make, and how can you sidestep them? Chasing the next big thing. One of the most common mistakes investors make is chasing hot stocks or trying to time the market. The allure of quick riches often leads people to jump on trends without fully understanding the companies they're investing in. Remember the dot-com bubble of the late 1990s? Thousands of investors poured money into tech companies with little to no revenue, betting on hype instead of fundamentals. When the bubble burst, fortunes were wiped out almost overnight. This kind of speculative behavior persists even today. Think about the meme stock frenzy of 2021, where companies like GameStop and AMC saw their stock prices skyrocket due to social media-fueled excitement. While some lucky investors made money, many others who joined the bandwagon late suffered significant losses when the hype fizzled out. The lesson here is simple: avoid chasing the next big thing without doing your homework. A solid investment strategy focuses on long-term growth and a deep understanding of what you're investing in. Trying to get rich quickly often leads to disappointment and financial setbacks. Ignoring the importance of diversification. Another huge mistake is failing to diversify your portfolio. Imagine putting all your savings into one company, believing that it's a surefire winner. This is what happened to many employees at Enron in the early 2000s. They invested their retirement savings heavily in their employer's stock, confident in its success. When the company went bankrupt due to widespread fraud, those employees lost everything. Diversification is the practice of spreading your investments across different asset classes, industries, and regions to reduce risk. Think of it as not putting all your eggs in one basket. For example, if you own a mix of tech stocks, healthcare stocks, bonds, and international funds, the underperformance of one sector is less likely to derail your overall portfolio. Neglecting diversification is like driving without a seatbelt. You might get away with it for a while, but eventually, you're bound to regret it. A well-diversified portfolio is your best defense against market volatility and unforeseen events. Letting emotions dictate decisions. Emotional decision-making is perhaps the most dangerous trap for investors. Fear and greed are two emotions that can wreak havoc on a portfolio. Fear often leads to panic selling during market downturns, locking in losses and missing out on potential recoveries. This was evident during the 2008 financial crisis, when many investors sold their stocks at rock-bottom prices, only to see the market recover and hit new highs in the following years. On the flip side, greed can push investors to take unnecessary risks, such as buying overhyped stocks at inflated prices. A prime example of this was the cryptocurrency boom of 2017, when many people invested in digital coins without understanding the technology or risks involved. When the market crashed, those who had overextended themselves faced severe losses. To avoid emotional investing, it's crucial to have a well-thought-out plan and stick to it. If you've done your research and believe in your investments, temporary market fluctuations shouldn't deter you. Developing discipline and focusing on long-term goals can help you navigate even the most turbulent times. Overlooking the power of fees and expenses. Fees and expenses might seem insignificant at first glance, but over time, they can have a substantial impact on your returns. Many investors overlook the cost of actively managed funds or frequent trading, assuming these expenses are negligible. In reality, high fees can erode your gains significantly, especially when compounded over decades. Consider this example. An investment portfolio with an annual return of 7%, but a 2% management fee will grow much slower than one with a 0.5% fee. Over 30 years, the difference could amount to hundreds of thousands of dollars. Investors who fail to account for these costs are effectively giving away a portion of their returns. Opting for low-cost index funds, or ETFs, is a smart way to minimize fees while still achieving market-level returns. Always read the fine print and understand the true cost of your investments before committing your money. Ignoring the basics of financial education. Perhaps the most fundamental mistake investors make is diving into the market without a solid understanding of how it works. Investing is not gambling. It requires knowledge, research, and patience. Yet many people jump in blindly, relying on tips from friends or social media rather than educating themselves about key concepts like risk management, compound interest, and asset allocation. Imagine trying to fly a plane without any training. You might get off the ground, but chances are you'll crash sooner rather than later. The same principle applies to investing. Without a basic understanding of financial principles, it's easy to fall victim to scams, make impulsive decisions, or fail to capitalize on opportunities. Investing in your financial education is one of the best investments you can make. Whether it's reading books, attending seminars, or following credible financial experts, taking the time to learn will pay dividends, literally and figuratively, over the long term. Investing in the stock market can be incredibly rewarding, but it's not without its challenges. And you learn the most by facing those challenges. Therefore, the biggest mistake is not starting. Watch the next video if you want to know why you should stop saving up and start investing.